Right. So, welcome to The Beast Awakens. And thank you, Dilshan, and thank you, Kanishka, for joining us. Uh, we have a conversation. We think this will take a little over an hour. Um, and, uh, and let me give you a little bit of background about uh, why we picked this topic, right? Sri Lanka is going through Sri Lanka's economy is going through a fairly tumultuous time, it appears, and uh, and the choices that confront it are aren't easy ones for anybody dealing with statecraft currently to have to deal with, and this is potentially also going to challenge those of who are allocating assets or investing for the next few years, because the macroeconomic outcome or a top-down view of what is going to likely to happen in the economy is crucial for decision making, because it is likely that very few sectors or industries or companies in the economy can or will be able to ignore what is happening. So this is the background for what we are talking about. And with us today is Dilshan Wirasekara. Dilshan is the chief executive of First Capital Holdings. Dilshan, this is an this is a challenging time, I think, to be allocating assets. Can you tell us about the portfolio that you are essentially overlooking at First Capital? How large is it, and what does it consist of?
Sure, Shamindra, thank you very much, and thank you for having me in this forum. And again, a warm welcome, I think, to all the people who joined us. I'm not sure I agree with the heading of our the beast, because I really don't see it as a beast. I believe it's a beast that can be tamed, so I'm not too worried about inflation to speak about that first. From a First Capital perspective, we are a fully fledged sort of investment banking operation. A large part of our business consists of the primary dealing of government securities. Apart from that, we are also into asset management, where we manage about 40 billion of funds. We on the PD business, we are the largest primary deal in the market. We contribute to about 15% of total issuances the government makes is taken up by us. We also we have equity brokerage, fairly small in size considering our other operations, and we have a corporate finance, debt structuring, dealing securities activity predominantly in the fixed income space, where we structure average of about anywhere between 25 to 40 billion of debt a year. And that's a sort of a fee-based income. So that's in essence what we do at First Capital.
So you are managing actively a portfolio of about 40 billion. That is in addition your primary dealership and your own the bonds you hold on your own account are in addition to the 40 billion. Do you want to put a figure? Can you put a figure to the bond portfolio?
So yeah, we can. I mean, that number changes based on how big we are in the market. Obviously, with current interest rate environment, we are not too bullish on bonds. So we've deleveraged our portfolio. But I think our balance sheet size as of September, the last published dates, which I can disclose, probably all put together is close to about 80 billion.
Okay. Okay. So our next speaker is Kanishka Manakkara. Kanishka, thanks for joining us. And Kanishka is the chief executive of CAL Investments, right? CAL is an investment bank. It is also a primary dealer, but you are not in the primary dealership of CAL, but you do manage assets, Kanishka. Can you tell us what you do there? You are on mute.
Thanks for having me, Samitra, and thank you everybody for joining. Good afternoon to all. Happy Friday. So as you rightly said, I'm the CEO of CAL Investments. We manage around about 60 billion rupees in client assets between unit trust and private wealth management. But Cal Investments is a part of the Capital Alliance Group. We're a fully-fledged investment bank, investment banking, and stockbroking and asset management. And yeah, hi Nilu. Good afternoon.
Hi.
Hi, we are live, by the way. No worries. Thanks for making
Technology this. Have you all started?
Yes, we are live.
Continue.
Okay, yeah, we're just live. So, Kanishka,
Hi, everybody.
We were just explaining what we do, but you already know this.
So, Kanishka,
Okay,
just in
great.
case, Kanishka, we missed that. I think the last bit. You manage assets of about
60 billion, roughly.
roughly. And whose assets are these?
So it's completely third-party client assets.
Right.
So it's corporates, high net worth individuals. We have retail products in us as well, which have sort of large numbers of unit holders. And we do private wealth management for the higher net worth individuals. And so, as I said, Cal Investments is a part of the Cal Group. We do all investment banking activities. We also have a primary dealership, stockbroking, corporate finance.
Super. Nilu, great to have you. We've just started. We held up the show for you a little bit.
Thank you. I'm honored.
We've been asking everybody what they do, basically, just to get a very quick background on Nilu. You are the chief executive currently of SoftLogic Invest. So I'm assuming this is the asset management arm of SoftLogic. It manages SoftLogic Group's assets. Is that a correct interpretation?
Yeah. So just to give a synopsis, so SoftLogic Asset Management is the asset management company of the SoftLogic Holdings Group. We have 27 billion plus in management, where we manage the life insurance portfolio of SoftLogic Life portfolio, and then we have discretionary portfolio management clients, and also we recently launched SoftLogic Invest. That is the retail side of the asset management side through money market fund and the equity fund. So that's kind of the background on what SoftLogic Asset Management is all about. So it's a mix of own funds and external funds as well.
Right. As we start off this conversation, and I'll ask Dilshan to start off, right? I'd like each of you to take a couple of minutes, not more than a couple, okay, maybe 3, and set forth any thoughts that you have, particularly with a focus about the macro outlook, right? I think we are going to spend a substantial amount of time discussing the macro outlook and then talk asset classes, if at all, right? And this is an open 3 minutes. You can choose what ideas you want to put forth here. Dilshan, may I ask you to start?
Yeah, thanks, Shamindra. So, I mean, we all know it's been a tough year. It's been a year we've, unprecedented challenges that we've never seen before. We are going to have the largest contraction in our economy we've ever seen. We are estimating that would probably be around 5.8% negative growth for 2020. However, I think it's important to choose to be optimistic in this environment, and I, for one, always believe positive thoughts would convert into positive deeds, and so on and so forth. So I think we've sort of hit rock bottom, and it can probably only get better from here. How I see things pan out, essentially the biggest issue I think that we face is a revenue constraint, and that is largely because we've cut taxes. A lot of our taxes are anyway taken in at the border. They are import-related taxations which the government has lost. So I think the biggest concern really is, the lost revenue. How would you really recoup that back? How would you get that? And I think that's really anyone who has the answer to that question then probably can predict a lot of other things. But like I said, I mean, we feel we can only get better from where we are currently. We are looking at 2021 quite optimistically. Our projections are that the economy will grow about 2.5% to 3% positive growth. So from the almost 6% negative growth we'll see this year. Based on that, I think when we go into the discussion, we can talk about the different aspects of, inflation and interest rates or equity markets, so on and so forth. But essentially, my take is I think we've had the worst year that we've ever seen in our lifetime. And I mean, I can't see it get worse from here. I can only see it get better.
Okay, Kanishka, we've hit rock bottom. Do you agree with that? There's some big debt payments, foreign currency debt payments coming up. Is this rock bottom?
I also do think so. And actually, maybe for the first time in my life, I'm more optimistic than Dilshan, perhaps. Look, I think rock bottom was a few months ago. I am of the view that we are in the second half of this crisis. I don't think the crisis is over, but we are in the second half of it. And I do think from a global perspective, you're going to see more positive news than negative news emerging over the next 12 months. There'll be positive and negative for sure, but it'll be more positive than negative. With that, I do expect sort of global economic activity to start coming back to normal from Q2, Q3 next year. In fact, our forecast for the second half of next year is that economic output might come back close to where it was in the second half of 2019. Maybe a few points below, but close. And when you consider that we are likely to see a 6% GDP contraction this year, what you're talking about is really, I mean, just from a mathematical perspective, a very high growth number next year. Because you go from 100 to 94, going back up 6% doesn't take you back up to 100. Just to explain that. So we are actually expecting, and it's a quarter on quarter, it looks quite different, where Q1 is actually, we are still forecasting to be still into negative growth territory. But in Q2, Q3 and Q4, we are seeing very sharp upward movements. And I want to caution people not to read too much into that. If you see an 8% or a 9% growth number in one of those quarters, that doesn't really mean you're becoming China. What it just means is that you're taking up that slack in the economy. Overall, so we do see a recovery coming next year. I am expecting inflation to be back with a vengeance, and that's something that we feel you should watch out for. We are also, and I think the rupee may come under pressure in the second half.
Cool, thank you for that. And Nilu will bring you in. Take a deep breath.
So I'm going to start with, normally when you read a book, you start with the first page, right? So I'm going to go to the back, the conclusion, where I feel the economies will spring back to life and rebound. Because if you see this current pandemic that we are witnessing or living through is a century event, right? So it is, Sri Lanka is no different to what's happening globally, and it's a global thing. It's this black swan event is a global thing, and so I believe that whatever we are going through or whatever the world is going to we are going to bounce back strongly. It's a phenomena that the bounce back will be stronger and quicker than what we envisage. That's the conclusion I would have. But saying that, of course, there would be yo-yo between the different quarters results. Now, you could see even in this year, in the first quarter, we had a negative 1.6% GDP, negative GDP. And in the second quarter, we had a huge, with wave 1 hitting us, we had 16% contraction. And then the third quarter, we bounced back to positive territory, and likely to see also a negative in the fourth quarter. And our forecast is that we would be close upon 6% negative GDP growth, like Kanishka also mentioned. So that's the kind of yo-yo kind of quarterly we will see, and it will continue also into 2021. The swings will be there in 2021. It's not going to be a smooth recovery, but the world is going to come back, like we have seen in other events. and the comeback would be stronger.
Right. So, very quick question to each of you, right? Let's like Kanishka said, 6% minus and 6% plus doesn't mean you get to the same place, but let's assume it does, right? How many of you think we will make our 20 in the next 1 year, in 2021, that we can restore, the GDP, that the decline that we had in 2020? Do you think we can fully restore that in 2021?
I think it depends on which quarter you ask.
Okay, so we've had wild swings. So let's average it out, right? We had a first quarter this in 2020 that was unaffected by this crisis, right? And then 3 quarters that are likely going to be impacted, right? So we can't really do a very accurate quarter-on-quarter thing because swings have been too wild. But generally, do you think we will restore this?
So that's the point. I feel towards the latter part of next year, towards the latter part of 2021, what we are seeing is output and economic activity coming back to where it was in the second half of 2019.
Okay.
But again, important to note that, I mean, even in the second half of 2019, we saw excess capacity in the economy. So things were not running at full steam even then. So that's something to bear in mind. But I do think we'll probably get back there.
Sure. Dilshan, again, we have this challenge. We've had 2 bad quarters.
Sure, yeah. So the simple answer to your question is no. I don't think we will get back to where we were. If you put it in terms of numbers, like I said, we are forecasting 6% contraction and a 3% growth for 2021. So you're not really getting back to where you were.
Right. And Nilu, very quickly.
Yeah, so for 2021, our forecasts are on between 4% to 5%. We are more positive, I would say. But the rebound, what could drive this growth would be, of course, tourism. We don't see it bouncing back in 2021 in a big way. We would go back to 2018 levels of tourism earnings only in 2022. So optimistic, but realistic as well. So where is this growth going to come? Is private sector credit growth needs to start picking up, and our forecast is around 9% next year. And consumption, thereby consumption has to pick up. And also we need to see remittances will fall next year because we had an unnatural growth of remittances this year because most of the workers coming back were losing their jobs, but they were bringing their money back. So that's not a good thing, not a sustainable thing in the future. The remittances will come down next year. And we feel, but the apparel industry, which is the export earning arm of Sri Lanka, would, of course, will have a rebound next year because the main 38% of our exports go to the US, which will have a positive GDP growth, and markets like UK and Europe also will see a recovery in terms of consumption next year. Because the vaccine, the most sentiment of the vaccine coming in these developed markets would be the first to benefit. So our exports would benefit more than tourism or other sectors in our country.
Right. And this is a quick note to everybody who's joined us, particularly if you are on the Zoom call, you have the option of dropping questions, and I would encourage you to do so. I think the panel can also see the questions. And we'll take them up as we go along. We may sort of integrate them into the conversation, or we can take them up individually. It depends on how the conversation goes. If you are on Facebook, and there's quite a few of you on Facebook, you can again drop a question onto the comments. We'll try to take that on. It's easier if you were, it's faster for us to take it on if you were on the Zoom call, right? Okay, now each of you have portfolios, ranging from 27 billion rupees upwards that you need to allocate, right? If COVID was a black swan event, it has now popped up a number of uncertainties or volatilities in the economic front that you potentially have to sort of have a forecast or have a thesis on to deploy the money that you have, right? Now, my question to you is, which of those forecasts, or which of those macroeconomic things that you have, variables that you have to have an opinion on, are most difficult to forecast in this environment, right? They are always forecasts, they are always based on opinion, right? Or based on research. You have to have that. There is no way you can manage a portfolio, but it is possibly tougher now. And which of those forecasts are the tougher to manage? Can I start with you, Dilshan? I mean, interest rates is a key one, but is that the most difficult one to forecast, or is there anything else?
I think, I mean, they're all probably equally difficult to forecast, Shamindra. But I would think more in terms of inflation really is a little bit harder for me to interpret, because so many other things affect that. So I would, if I had to pick one, I would say probably, our theme itself is the most difficult to really predict.
Okay, so reinforcing our theme, Kanishka, which of these is most difficult to forecast in the current environment?
I have a feeling the three of us will pick three different things. For me, it's really interest rates, and that's because we believe inflation is very likely to happen with the different equations we have in place. I see few scenarios in which we won't see an uptick in inflation next year. Interest rates are more, it's very policy driven, especially in Sri Lanka. And it's hard for us to forecast the kind of political pressure the government will be under in, say, 9 months or 10 months, to then forecast where the policymakers will want to take it. So over a very long period or over a medium term, 6 to 12 month period, I would say, I think you had mentioned, is it inflation, interest rates, or corporate earnings? For me, it's interest rates.
Nilu, which is the most difficult thing to forecast currently?
I would say for me would be interest rates, because inflation would have a role to play in what in interest rates would be. So nevertheless, for me, it would be interest rates to predict.
Okay, so then I have something for you, right? GDP growth, you get nominal GDP, remove the impact of inflation. Right now, you're all talking about a strong bounce back next year, right? And then you come to what we usually refer to as GDP, but it is the real GDP. It is the inflation removed effect. There is a GDP deflator. What do you think the GDP deflator, or inflation in general, is likely to be next year? If you are forecasting second half 2021 growth of 5%, what sort of inflation rate are you discounting there in the first place? I'll start with Kanishka.
So again, where it's not a flat number throughout the half. So like growth, I just wanted to clarify that I'm not expecting the entire year of 2021 to be like 19. It's that we are going to see sharp upward movement, and similarly with inflation. So we actually have a model for this, and our model is showing something coming closer to the 8 to 10% range by year end, which is a fairly significant uptick from where we are now. But that's right towards the end of the year. I want to caution, I'm not seeing too much inflationary pressure, say in June or July, but really it's October, November, December that we're expecting.
Dilshan, you're really concerned about inflation too. So, what's the number you think?
Not that I'm concerned, more so that I said it's more harder to predict. But I mean, not very different to what Kanishka's thinking is. I think we currently have inflation being targeted at 4 to 6% by central bank. We've managed to keep it within that range, I think, for the last couple of years. We've remained single-digit inflation post-war since 2009. So for a prolonged period of time, we've got used to single-digit inflation. If some of our maybe elder audiences may remember, we've dealt with inflation at 25%. So I've seen the 1-year T-bill rate at 25% in 2008. So I mean, a very, very different scenario now. Definitely it'll increase. I have no doubt about it, but I think that increase is going to be probably in the region of about 2 to 3% higher than where it is now. So if I, from the 4 to 6% range, which we've been having to date. If I had to really say what would it be for next year, again, like Kanishka said, it can swing, and probably that pressure would come towards the latter part of 2021. I would broadly say inflation will range between 6 to 8% in 2021.
Okay, and Nilu, your thoughts on inflation?
So inflation would very much depend on the aggregate demand and the private sector credit on the credit growth. So these are the two fundamental factors that would drive inflation. And what I believe is that this will not be pertinent up until the middle of next year. It still aggregate demand will be low, so inflation would remain at around 5% in 2021 mid-year. But thereafter, in the second half of 2021, I would say that with the credit growth picking up to 9%, forecast 9%, inflation rates could go up to about 7% year end. So it would be on a year on year would be about 6%, 6 to 7%.
All right. So if we are we are all, I think, anticipating private sector credit growth, or the banks to start lending or increase their quantum of lending to the private sector primarily, right, next year, but not exclusively to the private sector. The government may also become a big borrower next year, right? So in the question, on two of you said interest rates is the most difficult thing to forecast here, because I think a government has to, a policymaker has to watch several fronts here. Too low rates can cause put the rupee under pressure. It can make borrowing for the government and it can also cause inflation. So if we now switch to interest rates, and I think you may have a more nuanced expectation on it, right? You may have a quarter-on-quarter expectations on interest rates. What are you looking at? It's the most difficult thing to forecast, a couple of you said. Can I start with you, Nilu? How will interest rates impact next year?
Well, interest rates, it is at the end of the day, how is the country managing? Where are they going to raise the funding is the biggest question. Is it domestic? Is it external funding? These factors would have a major impact on domestic interest rates, right? So we are seeing if the country is going to put growth as a target, it's very evident with the central bank and the governor, state minister of finance saying they're all talking about growth of the economy, right? So to spur the growth, their policy is going to maintain interest rates as low as possible to kickstart the growth. So it looks like they are not going to IMF either till they have to. Till they no choice but go to IMF. So these kind of strategies that's what I said, it's going to be difficult to judge what interest rates are going to be. And if it turns, we are all seeing the bottom of interest rates currently. It cannot go beyond this point. It's doubtful. But if it turns, it can go 200, 300 basis points. So that's where I said the swing will be very much more than what we have been seeing, 250 basis point drop in interest rates in 2020. So the second priority is how are we going to manage the outflows? So if we are going to have the economy close, then the pressure is less eased for interest rates to go up. So several factors will impact interest rates, and then also the capacity to go and repay our external debt. We have never been in a position of repaying external debt. We have been always taking new debt and repaying the old debt. So that's the kind of philosophy that we have been following. And also debt to GDP ratios being in the 93% ratio level, our capacity to go out and borrow also in international markets is going to be very hard pressed. So these factors are all going to play a role in how interest rates are going to play. So that's why.
Okay, so if I can
that's why I believe that interest rates mid next year. Currently, we are seeing 1-year Treasury bill rates less than 5%. Next year, middle of next year, we would see it around 6.5%. And at end, I would see like a 7 to 7.5% 1-year treasury bill rate. So we are talking about a 200 basis points tick. And that also depends on basically the demand push. What is the demand in the market? If the demand is going to be low, right, then sustaining the interest rates at these levels will be an easy task. So that's why I think when the interest rates will go up, more like inflation would be in the latter part of 2021.
Dilshan, again, you're running a business that's fundamentally tied to interest rates, your fortunes. What's the expectation here?
So I also sort of agree with Nilu's thinking. I think we've seen rates bottom out. I don't believe there's room to ease rates further. Also, one important factor to remember is for the first time, I think we are seeing real rates being negative. We've historically, savers of this country are used to a 4 to 5% real return. So we've had interest rates discounted for inflation. Still, your money is growing at least a 4 to 5%. That's historically what we've had. I think for the first time now, we have negative rates. So people are moving away from fixed income really and looking at alternative asset classes. So I think rates have bottomed out. However, I think central bank seems to be focusing on modern monetary theory and going on the principle that you can print money and essentially kick the can down the road and keep prolonging your sort of problem. So that's the lifeline that we've seen happen. Currently, central bank holdings is at an all-time high of about 650 billion rupees.
Right.
So there's close to about, I think, 800 billion that has been printed this year alone. And part of that is reflected in the excess market liquidity. Currently, I think about 250 million in the bank market is in excess. However, I think the government also has clearly said that they will adopt local borrowing strategies. They are not going to go overseas. It's going to be more domestic borrowings that will fund the deficit. And that makes sense because the rates are low. Actually, the borrowing rates in rupees are cheaper than the borrowing rates for the government in dollars. Currently, the 1-year SLDB goes at 670. The 1-year T-bill is at 5%, right? So we've never sort of seen these things. But I think you're probably going to, once you sort of you keep coming to the domestic market to finance yourself in much larger volumes. And we've seen even currently, I think over the last maybe 3 months, the treasury bill and treasury bond issues have gone undersubscribed. So they are not raising the amount that they want to. And as a result, central bank is taking up the balance. And that holding is sort of ballooning. So
this raises the question, Dilshan, and this is also one of the questions we have on the board here. How and when can the central bank unwind this position, right? And if they want to unwind a large position, 600 billion plus, they unless the rates are higher, there won't be takers for this.
Yeah, a large part of that is anyway in treasury bill form. Of that 650 billion, I would say probably about 90% is in bill form. So it's going to mature within the next 12 months for sure. It's broken up 3, 6, 12 months. You will, over a period of 12 months, you'll have that holding maturing and going. So it depends how well can the government raise funds from anywhere else to repay that back. But I would think it wouldn't be, I wouldn't think central would come and dump that to the market because that will just be a sort of a shock to the system and rates will sort of go crazy. So going back to your first question is that I also feel for the next 6 months, we can still keep printing. We can still keep sustaining these low rates, but thereafter there'll be some pressure. So we are looking at 100 to 150 basis points increase for 2021 in the benchmark rates. But we also are looking at another further 100 basis points the following year in 2022. So I think we are getting somewhere close to where Nilu said the 1-year T-bill rate from 5 to 7.5. But I see that happening really not in 2021. That happening probably towards 2022, mid of 2022.
So I'm curious, right? The central bank can keep buying, as these bonds mature and it needs to be repaid. They can keep buying these bonds and releasing liquidity to the market, right? that is going to have the knock-on effect of inflation. Do you think in these 2 years that you're referring to, when you expect a 2.5% or 250 basis point, approximate rise in interest rate, the central bank can unwind at least partially this position?
I would think that they can, Shamindra, and I would think probably, one could argue, but what's the limit of printing? I don't think anyone is really going to look at that number, and I would think you could potentially go up to 2 trillion of printing and still be able to sustain that over a couple of years time in terms of retiring it. So I think there's still room. So that's why I say rates are not going to go up now immediately, but it will sort of only gradually start increasing in the latter part of 2021.
Sure. Yeah. Sure. Kanishka, I'll bring you in here. Again, same question, interest rates, where is it heading? And then now we got this, we're seeing a little bit of this beast, 650 billion-ish, mostly treasury bills held by the central bank. And that amount of money has been released into the market, printed and released.
Yeah, I guess I sort of similar ballpark to both Nilu and Dilshan, but maybe I would argue where we see things maybe a little more starkly than they do. I think rates have probably 200 to 300 basis points to go in 2021 itself. But despite that, I think what's important to remember is that we think inflation will go up faster than that. So you're talking about a drop in real interest rates. So an increase in nominal interest rates of maybe 2 to 3%, but also a drop in real interest rates of maybe 2.5%. And I think that's going to matter a lot. In terms of central bank being able to unwind its positions in 2021, I'm not quite sure it will be able to, because also remember there's a fairly substantial budget deficit that will get run up next year. We're for all the right reasons, we're going to go through fiscal stimulus. I don't think it's a bad thing at this time. I think the government's approach is right, but it is going to result in a large budget deficit. So there's going to be additional printing. I expect the central bank balance sheet to actually increase over the course of next year. And I suppose this is why I am expecting inflation to kick in as well, because that's
can you give us a forecast on inflation? You expect the central bank balance sheet to grow?
Yeah, no. So I think I mentioned that on the previous question. So towards the end of next year, we are expecting sort of 8 to 10% inflation, and then there's a real possibility of it going to double digits.
And do you think that trend will continue into 2022?
So this is the thing, right? Inflation, it's not like a thermostat that you can dial up and dial down when you want. So much of inflation is driven by expectations. And that's what's really dangerous about it. So once it gets going, it's not so easy to control. And Dilshan was very right pointing out to especially the latter part of the war when you had 20+% inflation. It took us a good 6 years to bring it under control, at least to a certain extent. So I'm not expecting it to go back up to where it was back then. By all accounts, things are different now. But once you open that Pandora's box, putting inflation back in place will not be that easy, in my view.
Nilu, any thoughts about how this liquidity, if and when, how it is going to be unwound by the central bank? Is that going to commence next year, you think? Or are we looking at this going on for several more years?
I'm kind of in the same tone as Dilshan, because I don't think the government will have capacity to unwind next year with budget deficits almost at 10%, right? But anyway, globally also, quantitative easing and printing money is the way that they are following, even in the developed economies. Now, if you see Japan and all, they printed so much, right? And look at inflation. Their inflation is near nothing, even after so much of printing. So this is the school of thought now that is coming in the modern day economists, right? So much of printing is happening, but inflation is not, you're not seeing inflation. So countries are continuing to do this, and Sri Lanka will, I think, are getting ready to follow this. And because we also have capacity now, because if you see our liquidity injection as a percentage of GDP, it's still 23%, whereas, sorry, it's about only 3.5%, whereas other economies like Japan and all is 23%. Of course, we don't have the same economic fundamentals, but nevertheless, we can go up much more. So the capacity from what we are today can be easily doubled and maintained. So I don't think they are going to worry too much about inflation. I mean, that is my perspective. So it will continue. That's what I believe.
Dilshan, you were telling us about 2008, right? That's not a whole very long time from, we are not very far from that, and it was 2025. I think it touched 30% at one point. And I think a factor about this modern monetary theory that people highlight about the disconnect is that we've got such a large foreign debt to pay. This is not all domestic. What are your thoughts on that? Are we sort of like getting Pandora out of the box here? We're opening Pandora's box, and will we be struggling with the 25% later on of inflation?
Samindra, I personally don't think we'll go there. The foreign debt repayment is obviously a big problem, and I think that's something the government, at least for now, seems to be still avoiding IMF and going for seeking assistance from them. But I think what they will try to do is probably sort it out through bilateral loans. So I would think going to friendly countries, maybe doing currency swaps, and taking care of maybe the next immediate 2 years. So I think 2021, 2022, there are heavy repayments. I would expect them to write that out through bilateral arrangements. And I think if those fail, only would we probably go seeking IMF sort of assistance. Just one thing on the inflation, Shamindra, my view, like I think we all agree rates are going to go up, inflation is going to go up, but I don't see that happening from a demand-driven side. So just because there's cash out there, I don't think people are going and consuming, right? That's really demand-driven inflation. So I don't think we will see demand-driven, but I expect to see a cost escalation. So on the supply side, things like a potential depreciation in the currency, because we have fairly low reserves, and we've seen when we do that, we sort of have a big depreciation in one go. Historically, we favored to do that than let it go little by little. You may see that, so that will drive the supply side and push the cost up. That drives inflation, but it's not a demand-driven inflation. So just to touch on that, but obviously, like I think we all know, debt repayment is one of the biggest problems we have. But how I see it panning out immediately, because you can't access international capital markets right now. ISPs are trading between 17 to 25% in the secondary market, so I can't think you can go and raise foreign currency at a reasonable rate today. So they would probably essentially go to China, India, friendly countries, and see whether they can get some bilateral arrangement. That's my thing.
Kanishka, anything you want to add here?
No, not. I think we've covered it. I think this the whole external debt side is something we need to be conscious about. I'm sure we'll have time to discuss it.
Okay, so let me get to this question of modern monetary theory. This is something new that's coming into the lexicon, generally speaking, and certainly it's we all started talking about this fairly recently, right? But it's I mean, people point it out, and there is also, you may see already a question there. Modern monetary theory is practiced mostly by countries with strong currency and reserve positions. Don't you think the approach is contradictory in Sri
Lanka? Okay, so maybe I'll give it a start. Look, So the question about modern monetary theory, and let's call it what it is. We're talking about money printing, right? And the key question is how much money printing is sustainable, right? So I think, and that's the crux of the matter. It's the extent to which we follow modern monetary theory or money printing or whatever name you want to call it. When there is slack in the economy, like there is now, there is space to print money, provide a stimulus without it necessarily becoming disastrously inflation, right? Similarly, what you've seen in Japan, it's not been so much economic slack as it has been. See, when you print money, that money needs to go somewhere in the system, right? And an asset price bubble, or that going into a sharp increase in asset prices can be one outlet for that money, which doesn't then lead to demand-driven inflation. That's what you have seen to an extent in the United States as well, where not only on the equity markets, which is really widely publicized, but there's been a huge asset price bubble, or whatever you want to call it, boom on the fixed income space as well in bond markets. So to the extent that, as we look at Sri Lanka right now, there's certainly space in terms of slack on the output side. There is probably space on asset prices as well, and space for asset prices to increase without it, given extremely low valuations that you're seeing, especially on the CSE. So there is some space for money printing, and there is some space for elements of modern monetary theory. I think the key question is to what extent, and how long, how sharp, how much of a deficit can you sustainably have? Is it 10%? Is it 8%? Is it 12%? And then how long can you sustain it for? Can you sustain it for 2 quarters, 4 quarters, or 8? I think that's where disagreements will be.
Nilu, any thoughts on MMT? You've already shared some, but this sector of we are not a country with a strong reserve position, and also
for sure. But then, of course, when the other countries are looking to MMT as a tool, right? So long as our percentage relative to the stronger currencies, stronger economies, if we do it as a percentage lower than what they are doing, I think it's still sustainable, and it's kind of a tool now that is being used by economists to manage. That's why they call it the modern monetary theory. So some of the conventional economists are being thrown out of the window with this kind of money printing. Those days we would think of it as a bad word. Now it's becoming a part of the new norm, I would say.
But if I may add something there, I don't know why people keep saying you need to have a strong reserve position to print money and get away with it. I'm not sure, because one is internal. You're talking about the domestic economy when you're talking about money printing, and reserves you're talking about the external sector. To me, they're two separate things.
Sure. Okay. Right.
That's why maybe Shamindra, we can use that as a tool, even though we don't have reserves, like what Kanishka is saying, right? Even without having strong reserves, you can continue to print money.
I think a factor to consider here is the possibility that we will have to use our reserves. We are already using, if you look at what's been happening over just the last couple of weeks, right? We are using up reserves to defend the currency currently. And then we also need to use the reserve to repay debt. And when you get to a weak position on reserves, then your choices become suddenly limited.
Shamindra, just in terms of stats, if you take net for the year, the central bank is still a net buyer of dollars in the market than selling. Sure. Very recently, over the last couple of weeks, they probably try to keep some pent-up demand from coming, primarily because the year-end rate matters for your numbers. So I would think they would probably maybe sell a limited amount just to keep it at the rate that they want to. But other than that, we've not really seen them practice selling off reserves to defend the currency, and I don't think they will do it either.
And if I can add to that, I mean, forget modern monetary theory. Regardless, trying to defend a certain psychological exchange rate is suicide, because you burn through your reserves so fast. So that in itself is a bad policy, and that's and as Dilshan said, that's not what the central bank has been doing. We've actually been buyers of dollars for most of this year.
Okay. If very quickly, if I can ask you again, what do you anticipate will happen to the currency? Say in a year from now, where will it be? Where will the rupee be to the dollar?
Shall I go first? Yeah. So we at the beginning of this year, we actually forecasted 186 to 191 as a range, and I think we will see it. It's currently at about 188, I believe, the spot rate. I think it will probably close somewhere thereabout, maybe even slightly appreciate to get it to the number. I believe 185 is the liked number. Whether we will actually get to 185, and I mean, you can achieve it in a matter of couple of days by selling a few dollars in the market, because our market is so thin. But for next year, we actually see touching 200. So 200 to 205 is our range for the currency for end of 2021.
Okay, Nilu, very quickly, what do you think? Anticipate on the exchange rate?
Similar, we would see it around 197, 200, 6 to 8% depreciation is what we see. But actually, what is most like to note here is that every 3 years we have been having huge depreciation coming in. Because if you saw in 2012, we had like a 12% depreciation. Then 2015, we had almost 10%, 9.9 or something. And then in 2018, we had a 19% depreciation. So my question is, 2021 is that 3-year mark. Would we have can everything blow out and have a huge depreciation? But given the facts that we are seeing now, I would say 200 would be an end target rate for currency.
Right. So in this environment, and several of all of you are saying it's a difficult environment around which to allocate assets, and this is what you professionally do. You have to do this. It is only a matter of switching assets, and not you can't just put your hands up and say, okay, I can't do this. Clearly, interest rates are low, so it's not the time potentially to get into fixed income, at least not for the long term. What are the options? Like, you're just looking at equity here. How do you make? How do you look for opportunities in this climate? What's the outlook like? Can I ask Dilshan to go first?
Sure. So I think, Shamin, in Sri Lanka, you broadly have 3 asset classes. An ordinary person can invest. You have fixed income, you have equity, and you have real estate, right? We don't have too much of other complicated instruments. Very broadly speaking, those are the 3 asset classes. So I think, our advice when we look at clients is to have a mix of on your portfolio. The weightages may shift. We wouldn't advocate go into one asset class, totally sort of gear yourself on one asset class. So I think having a mix and not putting all your eggs in one basket is important, fundamental of investing. But I would be more bullish on the equity and the real estate aspect, and less so on the fixed income, purely because rates are low. Like we all spoke of, we are looking at negative real returns. So fixed income is not going to be a hot favorite. You would obviously have some portfolio allocation, but I would be more bullish on equity, and I would also be a little bit bullish on real estate, because I think we will see asset prices move up just because there is so much of excess cash, and we know specifically the government has issued guidelines to banks to give housing loans at 7%, fixed for 5 years, and APLR plus 1.5% thereafter. So I know a lot of people are looking at that and saying, okay, I want to borrow just to get that 7% yield and then go and invest in real estate. So I would think those two would probably outdo fixed income. But like I said, we wouldn't advise anyone to put everything into one asset class. We see equity markets broadly. Our forecast for ASPI next year is about 7,500. So we are looking at from where it is now, potentially maybe 12 to 15% return on average on the index. And on real estate prices also, I think we'll probably, the index that we have doesn't truly reflect, I think, true prices, because if you look at, the Colombo condominium market to more suburban, they move in sort of different directions. So I would think even on real estate, we'll see probably more than 10% in terms of price appreciation on average. So I would really be heavy more on equity and real estate and a little low on the fixed income, and wait for rates to sort of peak. We all agree rates will go up. So probably 2021 is a year to be more bullish on the other asset classes, and then probably switch from there to fixed income when rates move up. That would be my broad strategy.
Nilu, can I bring you in about equity? Clearly, fixed income is not what anybody is looking at. And if you anticipate inflation, then staying liquid and staying in cash is also not a good idea. So that leaves you very narrow choices.
Yes. So I'm, of course, our asset house is very much skewed and positive on the equity side. We feel like the multiples, if you see the trailing 12 months earnings, currently September quarter, we are seeing at around 14 times multiple. It will go up end of by December, because the last quarter would be bad with the second wave. But however, 2021, we would see multiples coming down to about 12.5 times, and see market earnings growth of about minimum 30%, right? So of course, a lot of people would say that we are coming from a lower base, so therefore having 30% would be not so attractive. But nevertheless, we are going to see that 30%. And I would say equity markets are always forward thinking, right? You're buying on future earnings of companies. So this asset class would be primarily doing very much better than even real estate, because real estate would take some time for value to set in, right? So if I was an investor allocating my funds, I would take a very strong position on equity, then real estate, and of course, like what we discussed on the interest rates, fixed income side, we would take a very 30 to 40% exposure, and that too would be a short duration portfolio, whereas equity would be my primary asset allocation class.
Kanishka.
Yeah, going third, I'm saying the same thing. Look, protecting against the downside risk coming from inflation is critical. So take exposure into real assets. Equity is a real asset because you're buying a real business. Real estate is a real asset. There are the real assets out there. And it's also worth remembering that inflation is equity positive. If you run a business and you have 10% inflation, if you do nothing, hopefully your business should generate 10% more profits. So that's something that you need to bear in mind when you're looking at a market like this. I think it's important not to get carried away by the PER numbers, because E is at is really below potential. So I am a firm believer in profit potential in a business. I know the profit potential of my business, which is the amount of money you can make under normal circumstances if nothing's really going wrong. If it is depressed below that for some extenuating circumstance, COVID being a prime example, that snap back to normal happens much faster. So you as Nilu said, you'll see very high earnings growth in a lot of businesses, and then suddenly you'll see that PE multiples shift very dramatically. So it's important to be careful thinking about trailing price earnings in an environment.
Okay, so let me ask you about what you anticipate on earnings in 2021, earnings growth, right? Because the PER, the ratio, price to earnings ratio is fairly high. It can maybe it's a lead indicator of expected higher earnings. And just to put some context, we've had 2 years of declining earnings. Can somebody can maybe I ask again, Kanishka, since your microphone is on, we've had 2 years of declining earnings, and what do you think will be the earnings growth generally in 2021, market-wide, if that's?
Yeah, so we tend to look at it more micro than macro on something like earnings.
Sure.
Out of the economic indicators, we really focus a lot on the macro, but on things like earnings, we focus on micro. So let me start talking about sectors rather than,
Sure.
whole market. Anyway, that's not as relevant. We don't have ETFs really on the SBI. I do expect finance sector, for example, to see some earnings growth. I know there's a potential headwind from these NPLs coming, but there's going to be a combination of window dressing in terms of the government allowing banks to not recognize NPLs. And also, again, inflation is NPL positive as well. I keep talking about all these things. We need to be aware that inflation has many different impacts. But one of the things that inflation does is your loan is now worth less, 1 year down the line, and your ability to repay that loan becomes a little bit easier. So we do expect earnings bounce back. Huge upside on tourism, not in 2021, but really 2022. But at least, some of that negative part will go away. Consumption, we see continuing to do reasonably okay, especially in the first half. Second half, we might see headwinds. But overall, we are seeing growth in a lot of business.
So if you put some numbers on it, if you put some sector-wide numbers, if that's possible, what is the financial sector expected to do? That is half the market, I think, right?
Yeah, you've got, because essentially I do look at this so much on a micro level, but I'm seeing sort of 30-40% earnings growth in some of the counters that we are following.
Mostly banks.
Some of the banks, yes. The ones when you're thinking about bank earnings, it's important to look at what exposures that they have, and also how aggressive those banks have been in, because NPL is really the big driver of profitability, to which you have impairments next year will determine the success and failure, and it's not a uniform thing in our view. Different people have different levels of aggressiveness in terms of how they impair their bad debts. So you need really, for me, earnings is a micro thing. It's not a macro.
Dilshan, can I bring you in on earnings? And you may have a certain way of looking at it, but yeah, tell us about that.
Yeah, so I think I fully agree with what Kanishka and Nilu have sort of expressed. So I also see earnings in general. I mean, I'm taking a more macro view on markets improving in 2021 for sure. I mean, we've already seen third quarter earnings up 63% of listed firms for the September quarter. So I think we are probably over with the negative earnings trend we had for the last 2 years. Albeit the fact that the fourth quarter may be again go negative because we went into second lockdown. But thereafter, I think earnings are going to grow. So no doubt about that. I think one important thing to remember is that if you compare with regional markets, PE ratios, we stand fairly low. I mean, we are still trading at one-time price to book. I think Nilu said it's a PE of 12 or a little below, I believe, current. But if you look at other markets, they're trading at around 17, 18 in terms of multiples. So there is room for valuations to really go up without earnings really increasing either. That's number one. Number two is, I think we're talking of fundamentals here, but we shouldn't forget sentiment. A lot of our stock market is driven by sentiment, for good or bad. So that also can sort of exaggerate and take the market to a level that maybe on valuation someone will later on say it's high. But I mean, I wouldn't write off the fact that market could go from a current 12 multiple of PE to maybe even a 20. And thereafter then come back down again. So I think sentiment is also a very important factor. And I think in an environment where you have high liquidity and low interest rates, you're seeing people just shift. Just to give you some stats, because I know this, I sit on the board of the Colombo Stock Exchange. They launched an app, a digital app where you can essentially now seamlessly download app and open a CDS account and start trading online. We've had, I think, about 7,000 accounts being submitted and opened since we launched it in November. So not even 2 months. So there's a lot of interest. Now that has to be taken in context of we have about 200,000 CDS accounts only in this country, and really 70,000 who are active traders. That is at least one trade done in the year. So we only had 70,000 people. Now, if you take in that context, we've got 7,000 new accounts, and all of these are actually young generation. So these are 20 to 35 year demographic segment who is opening accounts. So I think there's a vast potential of new clients coming into equity that will sort of drive sentiment and drive the valuations maybe even higher than what it should be.
So am I to read, and also there is a question here also, that fundamentally it's not the fundamentals that are the primary driver of stock market participation or stock prices currently, but it's more sentiment?
In the current market context, to some extent, it is in the current market context. But I think over time, you can't avoid fundamentals. But I'm just giving a Sri Lankan perspective. Sure. If you look at trends that we've seen in the past, a lot of market boom happens not because of fundamental shifting and people saying, wow, companies are earning more money, so I think this has value. But there is a sort of a herd instinct that is there, and that build up is happening. So that's happening from an acquisition point of view in terms of new investors coming. It's also happening in terms of a bull run where everyone is seeing market, our market is up 9% YTD so far. So that's down from a 25. So we've had a 40% appreciation since May, right? Now, if someone looks at the equity portfolio and bought at that time, that's a huge gain. Right. So what we see is there is a lot of new clients coming in and focusing on that. And I think, sentiment is a part of markets. You can't avoid that. So it necessarily is not a bad thing. I'm not saying it's a bad thing.
Surely not a bad thing. But Nilu, you think it's more fundamental than sentiment right now?
Yeah, I think it's, it's unfair to say that, this is manipulation and all that stuff, because that's, for once I'm seeing the market at multiples which are attractive. And what's really good is that all the fundamental other factors for a buoyant market is in place. Like, for example, lower interest rates. Right now, prime lending rate is less than 6%. So imagine the corporate debt positions also. 2 years ago, your borrowings were 12%. Now you're talking about half of that. So, people are not seeing the benefits of lower interest rates also hitting corporate earnings, right? So also encourages people to borrow and expand their business operations or buy houses, whatever, so the whole environment, that low interest rate environment is going to lead to some asset classes doing better. And that would be the equity fundamentals. Also, the valuations of the companies will go lower when earnings start picking up. That's why I would say 30% earnings growth next year would be forecast. And I believe that this time around, it is the retail and the Sri Lankan investors who are buying in the market. That will show the strength to the market, unlike other times where we have seen global funds coming in and going out of the CSE, where it is always very short end or markets where when times are good, they'll be there, and then when other global things happen, they'll move their money. But this time around, because it's local driven, it's sustainable, right? If you see daily turnover over 2 billion on average, which is incredible, right? Where have we seen this kind of volumes coming? And that is because of low interest rates.
And do you anticipate, maybe Kanishka or Dilshan also, do you anticipate foreigners will come into this market anytime soon? Because given how their expectation on the external front, you can see that in IS international sovereign bonds and how they're trading currently. Will that have a bearing on foreigners coming into the market?
You go first, yeah, sure.
Okay. So I just from your reading your reactions, I feel maybe I'm more positive than the two of you on this. So look, one of the things I'm always keeping in mind is that starting in March, the US started printing money like never before. handing out, the average American worker got paid more being unemployed than they got paid, during having a job. And that's all printed money. Now that money works its way into a global system, and that money needs a home. All these pension funds, they have target yields that they need to hit, and you're not going to hit that yield investing in US treasuries earning 0.5% interest. So they are looking for yield, and it will be a matter of time before that cash starts finding its way into frontier markets. Now, what's holding it off is, everybody went into risk off mode. It's breathtaking how fast they moved back into risk on mode, global fund flows. And we've seen that into emerging markets with the very specific overhang on Sri Lanka with all the negative publicity we are seeing. We haven't seen any of that inflow coming in. But as a Sri Lankan investor, you need to keep an eye on the kind of catalysts that would make a foreign fund manager want to move money back here. And that could be some sort of IMF program that might come in the second half of next year. Just because we said no to the IMF now doesn't mean we've told the IMF, that we are never going to be interested in them in the future. So I do think global money flows can start coming back to Sri Lanka. I think that demand is there. I don't see it in the next 6 months, but second half of next year, I think is a possibility.
Will global money flows shift to Sri Lanka soon, Dilshan, again? Because
I don't think soon, Shaminka, but I think eventually it will. I think the current pandemic uncertainties around, our debt repayment, macro issues are probably keeping them away. But like Kanishka says, it's just a matter of time, and it's just one event that could be the trigger point that they start rushing back. And definitely, I think IMF program would be sort of one of those things. It's also, if you look at, I think central bank for the first time is giving you a currency hedge. A large part of foreign inflows, the concern has always been the exchange rate. It's not the outlook on the share or the earnings. It's more, when I convert it back, am I going to get my dollars? How much will I lose on the exchange? That has been fundamentally, I think, the issue for most foreigners to even pull out, not just from equity, but even from bond markets. So I think if you address that as well in terms of, and now the government actually is giving, I think for investments of over 10 billion, I can't remember the exact specification, a currency hedge up to 2 years. So you can come today, buy equity and get a guaranteed exchange rate, the same exchange rate that you essentially bring your dollars, take it back out in 2 years' time, which I think then gives you some comfort that I'm not taking risk on exchange. So like Kanishka said, I think it's a matter of time. I think they will come, and I also would probably, if I have to put money on it, say towards the second half of 2021 is when that will start happening.
All right, Dilshan, there's a quick question for you. Somebody wants to know what this CSE app is called. It's not Robinhood, but what is it called?
It's called the CSE. It's called the CSE mobile app. I don't think it has. So if you just go to Android or iStore and just sort of search for Colombo Stock Exchange mobile app, you'll get it.
And you can trade through the app, or do you need a brokerage account connected to it?
So you need to open it. What you can do is, for the first time, you can open the account digitally. So there is no paperwork required. You essentially take a selfie, fill the forms, and submit it through the app. You need to select a broker because you cannot trade. You have to have a broking account. So you need to drop down and select. There are 23 stockbrokers out in this market. You can select the broker you wish to, but the KYC and everything is eKYC. So the app actually is integrated with the DRP, where it can check the NIC against the photo to make sure that person is one and the same.
DRP being
Department for Registration of Persons.
Right. Okay. Awesome. Right. So we are bringing Sri Lanka into the Robinhood age in a way. Huh? That's if you're familiar, that's a very popular app in the US for trading equity. Okay, I will. We've taken some of the questions also. We paraphrased them or incorporated them into the conversation. One thing that's outstanding here is, do you anticipate M&A activity in the financial sector next year in 2021? Right. Again, by the looks of it, it looks like there is a divergence of fortunes. For one thing, like Kanishka said, we don't know what the bank balance sheets are really like until we sort of we don't know the effects of COVID on all banks for sure. But you've also seen this divergence of fortunes between finance companies and banks, or at least the medium to small sized finance companies and banks. What do you anticipate will happen? Will we finally see consolidation?
I think we will. I think we will in the NBFI sector. I don't think we will see it in the banking sector. Traditionally, the banks have never been able to agree on a merger. I can't see it happening this year. If you look at shareholding structures, they are pretty fragmented on the big banks. So, sort of, really making a case. And for a merge, it has to make economic sense. If you take some of the bigger banks, branch networks overlap, all that. So I don't know whether you can really achieve the cost efficiencies that you would want through a merger. I would still think the banking sector would resist. And I know most banks would just probably like to stay where they are today. But in the NBFI sector, I don't think there's a choice in the matter. In the NBFI sector, I think if you look at the 40 odd institutions we have, the top 20 are all right, or maybe the top 15 are fine. But the bottom 20 really don't comply with the capital adequacy requirements that Central has now imposed and will be increasing going forward. So I think it's a matter of time that there will be some form of consolidation. Personally, I feel we have too many NBFIs in the country, and that would be a good thing, I think, even for investors, because a larger financial institution, so less failures, and people will at least feel that their money is safer in a big organization than some of the smaller names. So in the NBFI sector, I would think it would happen.
Okay, with that, I will. I think we've had a conversation for a good hour and 15 minutes. We started a little late, but glad we could get everybody on board here. I'll ask each of you to put any final thoughts that you may have. Can I start with you, Nilu? We've had a wide discussion about macro and some discussion about asset classes, particularly equity. Any final thoughts?
Yeah, so I think when I started, I said I would read the end of the chapter. And I believe that the economies will spring back and the rebound would be stronger. But the pandemic, it all depends on the government initiative to manage it, and curtail it to a certain point. But however, Sri Lanka, I think, has been buffered in terms of what we are experiencing in terms of deaths and what other even developed economies are doing. So I think the bounce back would be much stronger, so long as we have a strong mandate. And what we fail to understand is that a new government has come in, but of course with the pandemic, right? But in Parliament, there's a stronger setting to take policy. So if policy consistency comes, we will see this economy going to a new level, right? So that is one factor, take home for everybody. I feel the strong government has been diluted because of the pandemic situation. But when that is all gone through, we will suddenly realize that we have a very strong government in place, and that is also will attract foreign investments, FDI. So FDI investments improving would be also for our reserves. Our reserves would go up, and that would be also, people are not taking that into account. Because if you see my office, I'm just overlooking the port city. Every day I see development happening. It's unbelievable what's taking place here. So some of us are blind to it, and so being positive is the way to go. Thank you, Shaminta, for having me over.
No problem. Just one more thing. Not that I want to dampen that, but you think we will go to the IMF in 2022?
I think it will be, and it's a good thing as well, because I think, like what we said, the time that we go to IMF, there will be a lot of global fund managers back again looking at Sri Lanka in better light. So it would be a good thing.
Okay, so we
But
also may have uncertainty for 2 years because I'm going to the
yeah,
IMF.
but the thing is, what we must realize is also, if you go to IMF currently at this juncture, right, they are going to put structural reforms, which is not possible. So delaying it is a good thing, I believe, because it will give us time to grow the balance sheet to some extent, and then go for the final bailout, kind of, not bailout, I won't say, but final help from IMF.
Kanishka, I'll start from there with you. We will go to the IMF, you think?
Freudian slip there.
Freudian indeed.
I think it's a possibility. I also agree with Nilu that everything the IMF is appears, we haven't seen the final draft of what they really are asking for, but certainly fiscal expansion, fiscal stimulus, I think is right for our economy at this time. And the steps the government is taking, yes, there's going to be money printing, there's going to be some inflation, but you have to think, what's the worst of two evils? So from a policy standpoint, I don't really, you can always argue on the small points, but directionally, I think, it's okay where we are going. And we are making the best of a difficult situation. If I were to leave concluding remarks, I'm a fund manager, so let's stick to what I think I know at least a little bit. It's prepare for inflation. Diversification is always necessary in your asset, in your portfolio, but think about that downside risk and that wealth erosion that can come from inflation. It's this now is a good time. We've had a sort of a 5 to 8 year period where it's been an amazing run on fixed income. And that can change. And that's a big shift even for the industry, because most of our assets are in fixed income. And that's a mindset shift that a lot of investors will need to make next year. We'll need to get a little more creative. I had a client who 18 months ago told me, look, Kanishka, if I can earn 14% on a fixed deposit, why the hell should I run a business or do anything else for that matter, because you're earning 14%. So investing will become less simple than that. You need to be a little more creative, and you need to think about how you can protect inflation. But the good news is there are alternatives and asset classes, and the SEC seems to be acting quite fast now. We got REIT legislation approved last year. I do expect that to come in as an asset class in the second half of next year. So I see all that as positive. Protect against inflation, be diversified. And one of the and I think Nilu touched on this. I think there's a certain amount of positivity. You're looking up from the bottom of a curve as we are right now. And one of the most enlightening things I read, in May when all was doom and gloom, was they said, somebody said that in a presentation, they said, don't underestimate the speed with which people will move back into risk on when the path seems clear. And I think that's already evidenced globally. And as this path clears further over the next 6 to 8 to 10 months, you're going to see a lot more risk on activity, and that has implications for different asset classes. So think of it from that perspective as well.
Okay, I will take you back, Dilshan, also to the IMF, bailout or not. Will we go to the fund? And then what are your closing thoughts?
Yeah, so I also think we'll probably be pushed to it probably towards maybe 2022. Really, I would think that, like I said earlier, the government would look at bilateral arrangements to tie up the problems that we have immediately over the next maybe 2 repayments that are due. I think it's inevitable that we will probably at some point go to the IMF. But I think, again, like the other panelists, it is a positive, and I think markets would take that as a positive. Concluding remarks, really, for me, I think one thing we need to remember as a nation, we've sort of been one of the most resilient countries. Don't forget what we've been through in terms of a war, April bombings, political turmoil, and now the pandemic. But I think as a nation, we've always proved to be resilient. We grew at 5% even during the war. So I am also very, very bullish in terms of the recovery story next year. And I think that will sort of happen. I think, like the other panelists, my favorite asset class also would be equity immediately, because I think that's where you probably are going to make significant gains. But like Kanishka mentioned, the other asset classes coming on board, like REITs. I can tell you there will be also sort of commodity-based products that will be introduced, like gold and stuff like that, that is coming. So I think market would generally have access to a more diverse range of products in terms of having in your portfolio. So that itself is exciting, I think, to all of us as fund managers. You'll have more options than what you've had before. So, I mean, overall, I think being positive is a big thing. I think that attitude itself will help, a lot. So I think we are seeing that. We are seeing the local fund managers really sort of being quite bullish on the recovery, and I think we've all agreed that it is a recovery, though we have some concerns on interest rates, inflation, and stuff like that. So I think we are in for probably good times in the next couple of years from a capital markets perspective, and as fund managers, I think exciting times to really be involved in this business. So yeah, that's it from me.
All right. Thank you. Thank you very much for those insights, everybody. And thank you for taking the time off to join us. I think we covered a lot of ground from all the way from MMT to PERs and what we anticipate will happen in 2021 and 2022. Everybody's bullish about equity. Everybody thinks, we have to overcome the challenges of those foreign bond payments this year and next. But we take the message that, I'll quote Kanishka for this, don't underestimate how fast risk on will come on. And that seems to be the message from at least three of you. So thank you very much for joining us. And thank you, Nilu, for, after all of that, all the drama. I think you were in the golf course.
Thank you, Shamindra, for tolerating and having me. Bye.
You got held up in the golf course, I heard. Yeah, but that's great that you
I would be disqualified on the golf course if I came late onto the team.
All right. All right.
It was wonderful. Thank you. Thank you, everybody, and have a good holiday season and happy 2021.
To all of you too, have a great season and a prosperous 2021. And for everybody who's joined us, thank you for being here. We had more than a couple of hundred people here. We had our Zoom call was full, and we had close to 100 people on Facebook. And lots more people will see this. So great. Thank you very much. I hope you all got something out of this. Okay. See you, everybody.
Thank you.
Bye.